and there's a new sheriff in town driving the US administration, and things are really going to get volatile and change, I choose to be optimistic about that.
And we can see that the lithium demand will probably go up by another 5 times over the next 15 years.
Welcome back to Rockstock Channel. It is Sunday, February 9th. I just concluded my inaugural Trump 2.0 lithium-ion bull, which I encourage you to read in conjunction with today's video. A link to that is in the description, but as a reminder, if you'd like to receive this newsletter directly, please register your email at rkequity.com or follow RK Equity on LinkedIn and on X at RK Equity Rocks. I watched Trump's inauguration after a day's skiing in Whistler from the Vancouver home of the man who got me into lithium more than 15 years ago, Jay Shemalauskas. Jay just completed a financing for his copper company, Camino Corp, which is focused on Chile and Peru and is worth following on X, at Camino Corp. Before he turned his attention in 2009 to what is today's Thacker Pass, Jay worked at the start of this century for many years with Robert Friedland focused on China, as did I. Jay and I share Friedland's optimism about how the critical mineral commodity investment thematic will evolve under Trump. I chose Blues Traveler's optimistic thought for today's video title, but equally could have used U2's Vertigo. I'm dizzy from trying to read the tea leaves contained within Trump's flurry of executive orders, tariff attacks, territory absorptions, and lots more. But ultimately, I believe that the Donald's energy emergency should be lithium positive, that energy dominance in the age of electricity means the deployment of all forms of electrical energy that is cheap, quick to deploy, and produced with reasonable cost-benefit environmental analysis. Trump-cutting regulations will rapidly speed deployment of these energy sources. What follows this introduction today are more excerpts from Friedland, who, in addition to all the talk of AI data center energy demand, discusses the competing imperative for metal from upgrading our entire military fleet with drones and robots. These applications will be enormously battery and metals intensive and could offer a lithium demand surprise as they are not well reflected in most analyst models. I've also excerpted from Tesla, GM, and Ford's earnings calls, as well as NextEra Energy, America's largest utility. NextEra, which produces electricity from fossil fuels, nuclear, and renewables, highlighted that above all other alternatives, battery storage, plus solar and wind, is not only ready now and fast to deploy, but is also the most economic and lowest cost answer to America's power needs. Reflecting on AI and data centers amid reports of China replicating America's large language models at a fraction of the CapEx, America's AI and cryptocurrency czar David Sachs talks about Jevons paradox, that DeepSeek and others commoditizing LLMs will result in much greater use and thus energy demand. Recall that I mentioned last November that CATL CEO Robin Zhang said that grid-scale batteries will be 10 times the market for EV batteries. I include in today's video comments from CATL co-founder who has introduced into the lithium narrative the concept of EIVs, I for intelligence, who suggests China would not have reached its now 50% EV penetration 10 years ahead of schedule if not for the sophisticated gadgetry of vehicles introduced by its technology companies. Those Chinese companies were for the first time the talk of the Consumer Electronics Show in Las Vegas last month, for which we include some commentary from recent Rockstock Channel guest Michael Dunne. China EV sales were strong in January despite the typical slow Lunar New Year period, continuing to benefit from trade-in subsidies. Geely January sales rose 25% month-on-month to a record 267,000 units sold, while BYD delivered over 296,000 EVs. Tesla's Model Y refresh and a new lower-cost model are coming very soon, as are its first humanoid robots. Meanwhile, Driverless robo-taxis will be in the wild in Austin by this summer. Spot spodumene has been ticking up in recent months, pushing $900, up from $700 last September. Reports that CATL is restarting its Jiangxi lepidolite mine spooked the market late last week, but I view this optimistically as a leading indicator of demand that CATL is best placed to see. Elon talking about battery constraints as a reason for slower EV production reinforces this view. Fast Markets is cautiously optimistic supply and demand, forecasting last week an oversupply of just 10,000 tons in 2025 and a deficit of 1,500 tons in 2026. CME hydroxide futures are in a constructive contango. The common denominator in all of Trump's talk about Greenland, Canada, and Ukraine is a recognition of the need for critical energy metals, both fossil fuels and non-fuel minerals. Tesla driver and Rio Tinto CEO Jakob Stausholm has no doubt the transition to electric vehicles is happening. While Benchmark sees 52 lithium mines producing 30,000 tons LCE as required to meet their 2.7 million ton forecast in just 5 years, Jakob's 15-year view is that 5 times growth by 2040 is in store. That's 4 million new tons, or 130 through new mines of 30,000 each. Buy low, sell high. My Lithium Bull Issue 101 includes some discussion of the trading histories of 2 lithium producers which have witnessed several bull-bear-bull markets, Lithium Argentina and PLS. For those attracted to conventional brines in Argentina, I think Lithium Argentina should attract inflows from Arcadium shareholders seeking to redeploy their lithium cash once the Rio acquisition is concluded. The company's chairman, John Kanellitsas, recently bought $2 million worth of LAR convertible bonds, a good sign. PLS, who I compare to Pilbara peer Fortescue Metals Group as the new force of spodumene, should also benefit for lovers of hard rock. CEO Dale Henderson also is on the tape with an insider buy of $1 million worth of shares late last year. It's hard to predict exactly how soon all the demand implied in the conversations that follow will impact the current oversupplied and underinvested upstream lithium market. But to paraphrase Elon, after laying the groundwork in 2025, I suspect we could experience another epic, ballistic lithium bull in the 2026 to 2028 period. In a similar way that Biden's IRA stimulated huge inflows into a clean energy, ESG, sustainability investment thematic, I see the potential for an emerging drill bit, baby drill bit, Trump thematic. Make mining and processing great again, which could catalyze an energy metals equity supercycle.
So we all know about electricity. You've been hearing people about demand for energy. Our electrical grids will crash and burn if you believe the demands we're talking about for artificial intelligence. You know, warfare is now driven by drones. If my drone, which is connected to AI software, has less latency from a satellite and access to more AI, it will kill you before you can kill me with your drone. And so military demand, sophisticated new armaments and technology are drawing as much of these critical raw materials or more than the energy transition. We've all been talking about greening the world of the economy for our kids, solar power, wind power, electrification of everything. But the raw materials we need to do that compete with military demand that is now going to infinity. Data centers alone are projected to use a total of 1,000 terawatt hours in the next 2 years. We've already had 3 of these. This is the 4th of these conferences. So that demand would be equal to all of the electrical consumption of Japan. And you know, markets are made at the margin. If I hold a telephone book out here at the end of my arm for 2 hours, I can probably do it. But after 2 hours, if I put a feather out there, it'll break my arm. So that's an incredible increase in energy demand. And Google searches, When you do a Google search, you use a very small quantum of energy, 1,000 joules. But an AI search uses between 10 times and 30 times more. So it'd be about, instead of using the power to run a 100-watt light bulb for 10 or 12 seconds, it's the power to run that light bulb for 3 or 4 minutes. And all your kids are going to be doing an endless amount of AI searches soon. Where is that electrical energy going to come from? And renewable energy is insanely, absurdly metals intensive. Those windmills are made out of steel, high-strength steel, and those blades have to be recycled. They only have a life of 20 years. An electric car is using 6 times the minerals of a conventional car. An offshore wind farm uses 9 times more minerals than just burning natural gas, which gets me back to remembering, thank God, for the Kingdom of Saudi Arabia and its energy endowment. This is the endowment that's keeping the world stable. This is the endowment of energy that built all the cities in the world. London, Los Angeles, and New York was built since the 1950s on this energy, and the idea that we can live without it is insane. We need every kind of energy we can stack up to solve this problem, because we're soon scheduled to have 10 billion people on this little mote of dust circling throughout the universe. Now, there's a reason why underwater power cables are so expensive. And everybody's building these things out at sea where these gigantic windmills are chewing up birds. I'm not sure that's the right thing to be doing, but those cables are insanely expensive. And now comes the United States military and NATO. Basically, everything you know of in post-World War II military equipment is obsolete. Elon is saying we don't need human beings in fighter jets. So the F-35 or F-19 American fighter jet, why is there a person in there when we can invent these robots to come and kill you at astronomical speed, but very material intensive?
In Q4, we set a record and delivered vehicles at an annualized rate of nearly 2 million a year. I was going to say doubling down on autonomy, but really it's like autonomy is like 10xing things. We launched the Cortex training cluster at Gigafactory Austin, which was a significant contributor to FSD advancement. And we continue to invest in training infrastructure at our Texas headquarters. The training needs for Optimus humanoid robot are probably at least ultimately 10x. The cost of training is dropping dramatically with time. We're launching unsupervised full self-driving as a paid service in Austin in June. Teslas will be in the wild with no one in them in June in Austin. We're trying to ramp output of stationary battery storage as quickly as possible. Once you have grid energy storage and home-based energy storage, the actual total energy output per year of the grid is dramatically greater than people think. Maybe it's at least double. This will drive the demand of stationary battery packs, and especially the grid scale ones, to insane, basically as much demand as we could possibly make. We made many critical investments in 2024 in manufacturing AI and robotics that will bear immense fruit in the future, immense. Like it's, in fact, to such a scale that it is difficult to comprehend. We'll continue to lay the groundwork for that in 2025. We're building the manufacturing lines. I'd like setting up for what I think will be an epic 2026 and a ridiculous 27 and 28. Ridiculously good. That is my prediction.
And we are also making significant progress on EVs. In 2024, we wholesaled 189,000 EVs and delivered more than 146,000 units. Recall at the end of the third quarter, we had around 100 days of EV dealer inventory so that customers would have the opportunity to see and experience our products. This strategy paid off, and we successfully reduced this to 70 days by year-end as our EV deliveries rose. As Mary highlighted, a big focus of the company has been improving EV profitability. We achieved variable profit positive on our EVs in the fourth quarter through continued manufacturing scale and efficiencies from higher production, improved material cost, including lower cell costs from scale and performance, and expansion of our EV portfolio with the launch of the Cadillac Escalade IQ and Sierra EV. There's more work to achieve our goal of a positive EBIT margin, but we believe we're making good progress. For instance, the Equinox EV has seen a $1,000 improvement in variable profit since its launch in just the second quarter of last year.
The level of subsidies that these companies have in China is very material, as well as these are digital vehicles with digital footprints and really deep into people's digital life. So we have to have the right policies around privacy, the right policies around national security, because these are not the cars of old. They're data collection machines. On the unfair part or the subsidy part, I think we will have to sort that out as a country because they're part of the competitive environment. When you list the kind of advantages the companies have, it's like a page long, right? So we have to resolve that. But in the end of the day, Adam, what I learned after 40 years in this industry is the company has to stand on its own, toe to toe, with the cost of those companies and the product appeal of those companies. We need to work with our government partners to make it a level playing field as much as possible. But in the end of the day, it's management's responsibility to beat the SU-7 straight up in a street fight. When you have a chance to spend time with Li Auto, some of the best EREV companies out there and their customers, what's interesting for me when we started to absorb this leadership team is we were really impressed that the customers thought of these vehicles as EVs. They do not think of them as hybrids or plug-ins. These are electric vehicles. They use 95% of the miles as electric and they plug them in every night. And the satisfaction is even higher because they're more affordable for people. The batteries is so much smaller with 150-mile range versus these huge batteries in three-row crossovers for 300 and 350-mile range. You're talking about tens and tens and tens of thousands of dollars. So for the customer, you're able to buy an electric vehicle that's fully comparable to an ICE vehicle in terms of cost. And because there's no transmission, there's no gears, there's no driveline, there's no duplicate axles, there's no duplicate powertrain, the incremental investment of fitting that combustion engine in there is very minimal for the customer. So I think at the consumer level, Americans love their big cars. They love their big trucks. That's what we do. We drive these big vehicles, but some people would love to feel that instant acceleration. They love to be able to drive by a gas station all the time. They love the feeling of electric, but they just can't get it. You know, it's $30,000, $40,000 too expensive for these big vehicles. So this technology gives them the electric experience without the range anxiety. Now, it's not perfect. If you tow, it's not a good technology. The batteries have to be too big. So it's not a panacea. But I think how we look at it is, given we're number 3 in hybrids, the Pro Power on Board thing really surprised us. People love hybrids for more than just fuel economy. And I think we see this in more degrees of hybrid and PHEVs as a solution for customers, EREV for certain kinds of vehicles, heavy vehicles that don't tow, and then pure EV for commercial or very affordable.
Zeekr, the 001 sedan starting at $50,000. The 009 luxury van, $110,000. Zeekr and Waymo have been co-developing robo-taxi fleets. As we head into 2025, here's the big picture. China is coming to your neighborhood. Whether you put the welcome sign up or not, they're coming. 1 in 4 exhibitors at CES were from China. China exported 6 million cars last year, up from just 1 million in 2020.
Today in China, we no longer call it EV. We call it EIV. I stands for intelligent, right? If you take out I part, EV or EIV penetration in China is no way going to, will reach over 30% in my estimate.
Suddenly, the battery and the software becomes the crucial parts.
To embrace innovation, all the CEOs' traditional sort of culture, they need to break through. They need to embrace new automaking in the new era, which has very heavy software component in it.
FPL is the largest electric utility in the U.S., and Energy Resources is the world's leader in renewables and storage. Together, we operate the largest natural gas-fired generation fleet in the country, are one of the largest nuclear operators in the U.S., and are widely viewed as an industry leader in transmission. We are one of the top 5 infrastructure investors in the United States, and we have invested more than $150 billion in our nation's energy infrastructure over the last decade, building everything from nuclear uprates, natural gas pipelines, and natural gas-fired generation to battery storage and renewables. Over the next 4 years alone, we plan to invest roughly $120 billion across the country, which would allow us to grow our combined fleet to roughly 121 gigawatts. Renewables and storage are ready now to meet that demand and will help lower power prices. Gas-fired generation is moving forward but won't be available at scale until 2030, and then only in certain pockets of the U.S. In addition, gas-fired generation is more expensive than it's been, with costs having more than doubled over the last 5 years due to the limited supply of gas turbines, a constrained supply chain, and much higher EPC costs. Nuclear continues to be a much longer-term option, in our opinion, due to first-of-a-kind risks and uncertainty, with nearer-term opportunities centered on recommissioning and uprate projects. Nuclear plants across the country are already serving existing demand, and there are only a few nuclear plants that can be recommissioned in the near term in an economic way.
Absolutely.
Yeah, so there's a thing called Jevons paradox, which kind of speaks to this concept. Satya actually tweeted about it, which is it's an economic concept where as the cost of a particular use goes down, the aggregate demand for all consumption of that thing goes up. So the basic idea is that as the price of AI gets cheaper and cheaper, we're going to want to use more and more of it. So you might actually get more spending on it in the aggregate.
That's right.
Because more and more applications will become
economically feasible.
Economically feasible, exactly.
Yeah.
That is, I think, a powerful argument for why companies are going to want to continue to innovate on frontier models. You guys are taking a very strong point of view that open source is definitely going to win, that the leading model companies are all going to get commoditized, and therefore there'll be no return on capital and basically continue to innovate on the frontier. I'm not sure that's true.
Indonesia has got nickel. Who knows how much nickel there will be in battery in the future. For sure, you'll need quite a lot of lithium. You need lithium from Latin America, from Africa, maybe some from Australia, some from Canada. So that's a global game. China is developing EVs, but they're very dependent on supply chains from other countries to support manufacturing. We are one of the world's largest producers of aluminium. We are a major producer of copper, and we are growing our copper production. If you think about going to EVs, they have much more aluminium, they have much more copper. For the battery, you need cobalt, nickel, and lithium. Who knows what the mixture is? But if you see the latest development of LFP, it's mainly about lithium. The lithium demand will probably go up by another 5 times over the next 15 years. Last year, we actually went in fairly big time on lithium. We started off in Argentina. We had first lithium in December in Argentina. We bought one of the world's largest lithium companies, Arcadium Lithium, which is getting close to closing. And we are now one of the biggest resource holders of lithium. The market might not be good today, but that's not how we think. We think much more about how do we see the world in 2030, in 2035, and in 2040, and we feel very comfortable about that. There will be a lot of demand for it.
And people have this impression that China is dominating the whole supply chain, and a lot of narratives are being spread about the threat posed by China. It's not true, because it overlooked one important aspect of the story. Look at the end market. China is accounting for disproportionate 70% of the overall market. So you need to look at both supply and demand perspective, right? So with the spread of EV in different markets in the world, we believe the production or the supply chain will also spread along that in different parts of the world. November, the EV penetration in China surpassed 50%. We expect by end of this year, will reach maybe 70%, and on average for the year, exceeding 60% in terms of total market penetration. Each party needs to do what they're good at. Public sector set up a very comprehensive framework. However, private sector has to have the vitality and entrepreneurship to make things happen.
The lithium market continues to take shape rapidly, care of technology improvements, government interventions, and energy transition drivers. 2024 was a year of many milestones for the lithium market, including global lithium demand totaled over 1 million tons LCE for the first time, growing by 30% year on year, Kira benchmark. Global EV sales reached more than 17 million units, growing by 23% year on year, or 3.4 million units on the prior year, the data Kira ProMotion. EVs themselves moved through a key inflection cost point within the China market. China EVs offering a more cost-competitive alternate to their internal combustion engine equivalent. The China's EV market penetration in the second half of 24 increased to roughly 50% of total sales, resulting in 11 million EV sales, or 64% of the global EV sales. So a remarkable step up there in China. As it relates to mass energy storage, or ESS, demand grew by an incredible 53% year on year, with 205 gigawatt hour of global storage deployments. This data, Kira ProMotion. What's behind this? Well, significant disruption is underway due to these rapid advancements in technology. Every day, more headlines are emerging for auto company mergers, breakthroughs in autonomous driving, ESS, and developments in electric vertical takeoff and landing, or eVTOL vehicles, as they're called, to name but a few. At the core of this disruption is a technology revolution where digital intelligence and electrification are intersecting, they're combining, and are self-reinforcing. Now, to share some of the recent anecdotes in this space which illustrate this, Jensen Huang, the CEO of NVIDIA, described a key part of the future of his company as predicated on three key growth areas for robots, being agent robots, self-driving cars, and humanoid robots. Now, I note all of these will need batteries, and I also note the distinction Jensen's made that cars are becoming robots. Also, the CATL co-chairman, Pan Zhan, spoke at the World Economic Forum recently, where he recharacterized EVs as EIV with I referencing intelligent. So again, another example of this digital influence combining with electrification. Now, moving to a more practical example is the incredible progress BYD has been making. BYD sold over 4.25 million passenger cars last year, positioning itself as the second largest EV manufacturer globally, just behind Tesla. BYD surpassed Toyota's EV sales in the Japanese market in 24, marking a significant milestone. And BYD officially entered the South Korean market this month, a bold move that brings it into direct competition with the domestic e-manufacturers in South Korea. So we continue to closely monitor BYD's advancements as it challenges established players in key markets worldwide. Another notable anecdote of supply chain disruption comes care of CATL. The battery maker CATL, of course, being one of the largest globally, launched what they've called their Bedrock chassis. This is an integrated product that provides not only the battery, but the full chassis integrated, and it's been safety tested. Thus, this change obviously changes the role of the battery maker, but further simplifies the automobile supply chain, and no doubt will lead to reduced costs, care of CATL's manufacturing scale. So we watch this with interest. So as you can see from these brief examples, much change is underway, and all of this change are growth markets, which of course the lithium market serves as a key subset. So moving to pricing. The lithium market has been rebalancing following the highs of calendar year 20 and 21. Following recent supply curtailments over the past year across the industry, we note that spodumene concentrate pricing has lifted off the lows of US $750 per tonne that we saw in October last year, and now moving into the range of between mid-850s to low 900s.